The current month of January is not a delivery month, and I think we're at 35 or 40 million ounces standing for delivery. That is the largest January delivery ever. Normally it's, a million, 2 million, 600,000. It's like nothing. There's no historically no deliveries get done in January. So for 30, 40 million ounces to be delivered in January, that's outstanding. I mean, it's an outlier.
It might make some sense to take some profits on gold on silver bullion if you have your profits, and to put some of that in silver miners that pay a dividend. You can see here the silver to SIL. SIL is the main silver ETF, and it's a decent proxy for the value of silver miners, though it's not perfect. You can see here the higher this number is, the cheaper silver miners are relative to silver. You can see here was the silver crash of 2020, and we went up to about 1.02.
According to Rafi Farber, the silver market is responding as though something is breaking beneath the surface rather than like a typical bull run. Backwardation continues to appear, physical supply appears to be limited, but futures activity is oddly quiet, indicating that metal is being quietly absorbed by real-world demand rather than being the result of frantic speculation. There are just not the typical pressure valves that would lower prices. Paper markets are separate from what's happening with real bullion, supplies aren't flooding exchanges, and shorts can't just intervene. This indicates to him that purchasers who need silver now, not later, are driving the move rather than hype or retail traders chasing momentum. Experienced investors are beginning to recognize a unique imbalance as miners continue to be historically cheap in relation to the metal itself. Although physical silver is still the best kind of protection, Farber contends that market pricing discrepancies point to both greater opportunities and greater threats, because the eventual release might be explosive when supply stress develops in a calm manner like this. Prices leap rather than meander upward. Be sure to like, subscribe, and hit the notification bell for more insights into gold, silver, and precious metals investing. Share your thoughts on the market in the comments below.
And now we're going to start talking about silver. So, what is going on in Shanghai? In Shanghai, the silver stocks in their exchanges are at a low that goes back to 2013. It's not a record low, but it's a recent low, and it keeps getting drained. We're at 506 tons, and this is the stuff that they take out in order to stockpile it for their solar panel manufacturing stuff. These are not stackers, these are industrial users, mainly drainage, Eli. Silver backwardation persists. Backwardation, it's not what I define as backwardation, but we're just going to use that word. I asked Keith Weiner about his opinion about backwardation and what backwardation means to him versus what it means to me. So this is his version of backwardation. I guess it kind of is. It means that silver spot prices that you can get in London are more expensive than New York futures prices. So I asked Keith, what does it mean when New York spot prices are more expensive than New York futures prices? He called that forward curve inversion instead of backwardation. Whatever term you use for it, forward curve inversion is a lot more extreme than silver backwardation between London. The supply of contracts in New York lowers since they are impossible to hedge profitably. The longer this persists, the higher the silver price is going to have to go until this backwardation is resolved. But anyway, so there's one problem in that, and it shows here that it's affecting the silver open interest market because open interest is not elevated here. There are no more contracts being sold now than otherwise. They're not very elevated at all. We have 155,000. I think it's 158,000, but this is pretty mid-tier, mid-level amount of contracts. And you'd think that short sellers would want to sell short here at $110 an ounce, but they can't, because to hedge it, it costs like $112 an ounce to hedge. So therefore, that keeps the supply of contracts low and elevates the futures contract. So this is not futures speculators that is driving the price here. Otherwise, you would see higher open interest, which is impossible right now. So what else could it be? Is it SLV? Is it retail ETF investors? No, it's not. Look at this. The blue line is the price of SLV. The black line is the amount of silver in the fund. We are not anywhere near a record high here. Record high was at Silver Squeeze at about 21,000 tons. We are now at, 16,000 tons. And you can see here, at the 2011 high, it kind of was SLV related because this, at that time, was a record high of the amount of silver in the SLV fund. Here, we're not anywhere near that. And if you zoom in, you can see here, this little box shows the interplay between the blue and the red lines. The blue is the price of SLV. The black is the amount of silver in SLV, supposedly. And you have here, at the time that SLV, the fund share price was $55, which means that silver was about 60, 62. I think there's like a $5 or $6 difference between them, something like that. You can see here we had a certain amount, whatever that amount is, of silver in the fund, dollars per share of SLV. We have about the same amount of silver from 55 to about 95. And it's been going down since this over here when silver was about 60. So it's not SLV hoarders, it's not retail buyers, it's not even institutional buyers of SLV. So it's not open interest in the futures, it's not SLV speculators, and also it's not the stackers either, because junk silver premiums are negative. They just plummeted to negative 3% suddenly. There was some kind of market adjustment here. We've been hovering around zero since November, and now there was a plummet to about negative 3%. So it costs more to buy a silver futures contract or silver in Shanghai in a contract than it does to buy junk silver, probably because it's not refined, and whoever's buying the silver now needs refined silver, and junk silver is not that. You can also see in Silver Eagles, the most expensive and popular of the silver. It's not even junk silver, it's more expensive. But even here you have a negative 2.55% premium on eBay. This is the main market for junk silver or silver coins. It's not the best price, but it's probably the most popular. I might be wrong about that, but a negative premium on eBay means, yeah, silver is cheaper than silver contracts. So there's something going on here. It's not the stackers. It's not the speculators. Now getting back to the point that I made at the beginning of the video, it might make some sense to take some profits on gold, on silver bullion if you have your profits, and to put some of that in silver miners that pay a dividend. You can see here the silver to SIL. SIL is the main silver ETF, and it's a decent proxy for the value of silver miners, though it's not perfect. You can see here the higher this number is, the cheaper silver miners are relative to silver. You can see here was the silver crash of 2020, and we went up to about 1.025. We're at 0.923. This is very near an all-time high. The all-time highs are over here at about 1.025. So silver miners are very undervalued relative to the silver price. So if you don't have any silver miners and you've wanted to get a position in those, now is not the worst time to do that and take some profits from your silver, either ETFs or whatever you have. I wouldn't exactly sell your physical, but if you have any silver derivatives, silver bullion derivatives, it might be an interesting idea, though I don't recommend anything, and this is all entertainment. I'm very, very funny.
Silver and gold are no longer presented as cyclical opportunities or straightforward transactions. They are turning into financial lifeboats in a system that is clearly under stress, according to Bill Holter. He contends that while sharp pullbacks, abrupt volatility, and even painful corrections are still probable, they are merely distractions within a much more significant structural shift. This market isn't being driven forward by hype or conjecture. Growing strain on the world, credit system, skyrocketing debt levels, and governments compelled to create money indefinitely to keep the system running are driving it upward. According to Holter, who studied credit and liquidity for more than 20 years in the brokerage industry, the true danger is not price fluctuations, but rather market collapse. Charts and technical indications become meaningless when there is a breakdown in confidence, and practical delivery becomes more important than paper promises. Timing the ideal exit in such a situation can quickly backfire, since once supply evaporates, there may be no way to get back in at any price. According to him, gold and silver are responding to the mounting threat of global currency devaluation and sovereign defaults rather than just inflation. Make sure to like, subscribe, and click the bell icon to get notified whenever we upload new content. We really appreciate your support.
Should we be selling? I'm going to tell you, or I'm going to ask you, if you sell, where do you put the money? What currency do you hold the money in? Where is anywhere in the world a credible currency that you can confidently hold that capital? The problem is there is no credible currency in the world today. So that's what's happening, is currencies are collapsing. The fiat system is failing. The experiment, what is it, 80-year experiment since 1944, Bretton Woods, and then again from 1971, that fiat experiment has failed. And people are seeing the failure, and they're getting their capital out of currencies and into real money, gold and silver. I mean, why are central banks buying gold? basically because they don't trust the large balances they have in dollars. They're worried about a gigantic black hole of nothingness where they had dollar holdings. So that's why they're buying gold is to plug up the holes that are going to be created by fiats. And just a perfect example, and I think I read the number this morning. Russia's admitted, and when I say admitted, I believe they have much more than what they're saying. But Russia's admitted gold reserves have risen $260 billion since the United States stole their $300 billion. So that's an example right there of a central bank holding gold that makes up for the losses in fiat currencies held or treasuries. So I mean I would stick with silver and gold. They are more money. I mean gold is pure money, but silver is more money, has a monetary history compared to palladium and platinum. There are no currencies anywhere on the planet to put your quote your winnings if you were to sell gold or sell silver. So okay, let's look at other assets. The only other asset that I can think of would be if you live in a city, you're not going to survive when this thing goes down. You've got to be outside of a city. You've got to be rural. So if you've got big winnings in gold and silver, take some of those winnings and relocate yourself and get the hell out of Dodge. The current month of January is not a delivery month. And I think we're at 35 or 40 million ounces standing for delivery. That is the largest January delivery ever. Normally it's, a million, 2 million, 600,000. It's like nothing. Historically, no deliveries get done in January. So for 30, 40 million ounces to be delivered in January, that's outstanding. I mean, it's an outlier. A big delivery month is March. So March 1st, we get first notice day and we'll find out what starts to stand. But what's happened over the last 2 or 3 years is that you start with, let's use the number of 100. You start with 100 contracts standing for delivery the first day of the month. And by the end of the month, you might be up to 200, 300 or more contracts standing for delivery. It used to be the other way around. You start with 100 and you end with 7. Now we're starting with 100 and ending up with 200 and 300. So what we're witnessing is contracts are being bought during the month with the express intent of taking delivery. And March, the month of March, that delivery month, very well could be the failure to deliver because there's only 120 million ounces available to deliver.
According to Bill Holter, the market's current situation indicates a significant credit event rather than merely typical swings. He cautions that authorities will no longer be able to regulate the enormous quantity of debt in the world if central bank policies fail. This could result in pandemonium since credit markets will be allowed to operate independently. He emphasizes that because gold represents underlying fiscal and credit issues rather than just inflation, it is moving in lockstep with Japanese bond yields. Holter claims that although people frequently believe that gold's main function is as a hedge against inflation, it actually serves as a safeguard against default and financial catastrophe. Additionally, he notes that selling gold or silver at this time isn't an easy choice because there isn't a stable currency to put the money in. The decades-long experiment with paper money since Bretton Woods and has demonstrated its limitations, and fiat currencies are collapsing globally. To safeguard themselves against these depreciating currencies, central banks, such as Russia, are expanding their gold reserves. In addition to financial planning, he suggests practical preparation. For individuals with substantial precious metal wealth, moving from cities to rural areas can be a safety measure because cities could not be secured during a serious emergency. He concludes by pointing out that the actual delivery of silver is hitting all-time highs. Strong real-world demand was evident in January, when 35 to 40 million ounces were waiting for delivery, much higher than usual levels. If you enjoyed this video, don't forget to hit the like button, subscribe to our channel, and turn on notifications so you're always up to date.